The Property Bulletin by London Property, the home of superprime.
Mortgage market update. What investors overseas buyers need to know. In a mixed week for UK mortgage rates, signals from top lenders suggest both opportunity and caution for property investors and international buyers managing UK assets. Nationwide leads with rate cuts. Nationwide has trimmed selected fixed-rate deals, now offering a 2-year fix at 3.9%, 60% LTV, with a £1,499 fee. Even borrowers with a 25% deposit, 75% LTV, can now access 4.04%, potentially offering value for those entering or refinancing in the prime or core residential market. Other lenders raise rates. Halifax and Co-op, now under Coventry BS, have moved in the opposite direction, increasing fixed rates by up to 0.27%, citing inflation concerns and rising swap rates. Clydesdale has also raised select broker deals to 4.3%, 65% LTV, with a £1,999 fee, still competitive in some investment scenarios. Larger loan flexibility. Yorkshire BS and Accord have lifted their maximum loan amounts, now up to 2.6 at higher LTVs and 5 loans below 75% LTV, broadening options for high net worth and portfolio clients. Key takeaways for investors and overseas buyers. Lock in early. Fixed rates are volatile. If you're planning a purchase or refinance, early action can secure better terms. Balance cost versus leverage. Competitive rates are still available at lower LTVs, ideal for capital-heavy strategies. Consider new builds. Lenders are now more open to higher LTV lending, up to 95%, even on new builds, a shift that supports rental demand and first-time buyer resale markets. Get in touch if you want help structuring your next purchase or review your finance strategy. Leasehold reform faces legal challenge, what it means for property investors. Britain's most powerful landowners are mounting a legal challenge to the Leasehold and Freehold Reform Act 24, a move that could impact long-term investment strategies and asset values in prime London. What's changing? The new act aims to rebalance power in favour of leaseholders. Key reforms include abolishing marriage value, significantly lowering the cost of lease extensions, capping ground rents, improving affordability and transparency, barring freeholders from passing legal and valuation costs to leaseholders during enfranchisement or lease extensions. For property investors, especially those with leasehold portfolios or blocks under management, these changes could impact cash flow, asset valuations, and exit strategies. Why the legal fight matters. Major landlords argue the Act infringes on their property rights under the Human Rights Act, threatening long-standing income models and devaluing premium central London assets. A win could delay or alter parts of the reform, but won't reverse Parliament's direction. A loss sets a precedent for broader leaseholder power. For overseas and portfolio investors, review leasehold exposure, particularly where short leases or marriage value play a role. Expect shifts in pricing models. Valuations may need adjusting to reflect reduced long-term freeholder income. Opportunities may arise. More affordable lease extensions could unlock resale or development potential. The outcome of this challenge won't just impact large estates. It will shape the leasehold landscape for investors, developers, and overseas buyers navigating the UK property market. Planning permissions drop. What investors need to watch in 2025. Fresh data from Investec shows a concerning slowdown in planning approvals across England, with just 241,000 units approved in 2024, a 3% year-on-year fall. For investors and developers, this could spell tighter supply and continued pressure on pricing, especially in undersupplied regions. London's shortfall. The capital remains a critical bottleneck. Only 32,000 homes were delivered in 2023, less than half of what's needed to meet demand. This adds further strain to rental stock and buyer competition in central and outer London zones. What's working in investors' favour? While planning remains tight, there are some positive indicators. Construction cost inflation fell to 2% in 2024, a sharp drop from previous years. Land values, particularly in central London and brownfield zones, have softened, offering opportunities for value-driven acquisitions. Partnership models gaining ground. Investec highlights the growing role of local authority private sector joint ventures, a structure that reduces risk and capital exposure. For institutional or overseas investors, this co-investment model could unlock pipeline deals in areas previously difficult to access. Strategic implications. Expect persistent supply constraints, particularly in high-demand markets. Land acquisition timing is key as costs normalize. Partnering with local authorities or housing associations may offer access and planning leverage. As planning slows but demand holds strong, savvy investors will need to balance short-term scarcity with long-term opportunity. Why Surrey is becoming the go-to family base for UK property wealth. Surrey has long appealed to high-net-worth individuals, but it's now firmly on the radar as a premium family hub for wealthy UK and overseas buyers. With 4 areas ranking in the top 10 of the Family Hotspot Index, it's not just about countryside charm. It's about smart, lifestyle-driven property investment. For those managing long-term UK property wealth, Surrey offers proximity to London with fast connections to key business districts, exceptional schools, both private and state, stability and growth in family-focused residential markets. A-list residents like Tom Hardy, Peter Crouch, Amanda Holden, Andy Murray, and Peter Andre have chosen Surrey for its blend of privacy, space, and lifestyle, often anchoring multi-million-pound homes designed for both comfort and investment longevity. With international buyers increasingly targeting suburban stock near top schools and greenbelt access, Surrey offers strong fundamentals, capital appreciation in key postcodes, consistent rental demand, high resale liquidity at the upper end. Whether you're planning a family move, diversifying your UK holdings, or looking for secure long-term returns, Surrey is a market to watch. London house prices dip, but buyers still priced out of the capital. Despite falling property values in some of London's most exclusive boroughs, affordability pressures continue to drive buyers, including professionals and young families, out of the capital in search of better value and space. High-end corrections, central boroughs like Westminster, 20.1%, Kensington and Chelsea, 15%, and Islington, 8.3%, have seen significant price drops year on year. Sellers are now accepting discounts of nearly 10% on average, even in traditionally bulletproof areas. Outer London and commuter belts holding firm. Meanwhile, boroughs like Lewisham, Havering, and Redbridge have seen positive growth, 8 to 9%, as demand shifts to more affordable zones. Affordability gap remains wide. The average Greater London home still costs 14 times the average salary, a major barrier for first-time buyers and even mid-career professionals. Rising stamp duty thresholds, muted wage growth, and elevated mortgage rates have added further strain. Buyers heading for space. With hybrid work now the norm, many are swapping one-bed flats in Zones 1-2 for family homes in the home counties or beyond. Lifestyle-led migration is reshaping demand, especially in towns offering good schools, green space, and realistic price points. Investor takeaway. Prime Central London offers potential long-term value entry points, particularly for cash-rich or overseas buyers. Commuter towns and outer zones continue to show resilience, supported by flexible work patterns and lower living costs. Rental yields remain strong, especially as would-be buyers continue to rent amid affordability constraints. With rates unlikely to drop below 4% this year, the market favors those ready to act with clarity and confidence, whether upgrading, investing, or diversifying a portfolio.
Subscribe to our newsletter to receive our weekly bulletins and stay ahead of what's shaping the super prime property market.